Yeah, my dear students, welcome to this new accounting standard in the series of Group 1, that is Accounting Standard 11. The effects of changes in foreign exchange rates. Now, see, friends, what is standard? Basically, we have to deal with something known as foreign currency transaction. This is the stuff to be revised. Then, para 46A, different accounting treatment. Then we have foreign operations. And of course, the last, forward contracts. So these are the four things which we'll be learning now. The effects of changes in foreign exchange rate, foreign currency transaction, para 46A, foreign operations and forward contracts. Now see, my dear students, the first area is nothing but foreign currency transaction. So what does the standard say? You can enter into a foreign currency transaction like purchase of goods, sale of goods, rendering of services, hire of services, purchase and sale of fixed assets, loan taken, loan given. So many kind of transactions can be done. Now, when these transactions are done in foreign currency, nothing but a currency which is other than my local currency. From our perspective, it is rupees. So, if I do a transaction in a currency which is other than rupees, that is nothing but foreign currency. So, I need to recognize this foreign currency transaction at which rate? Obviously, I have to recognize this foreign currency transaction at initial recognition rate. The rate at which the transaction is done is referred as initial recognition rate. Say on 1st of January 2019, I purchase goods worth $10,000 and I'm making payment on 15th April 2019. Now friends, if I'm purchasing goods worth rupees $10,000 on 1st January 2019, so what happens on 1st January 2019, I have to recognize the transaction at initial recognition rate. Nothing but the exchange rate on the date of transaction is initial recognition rate. Thereafterwards, there is a translation period, or I can say my balance sheet is prepared on 31st March 19. So what I have to do? I have to translate the foreign currency item in closing rate. Closing rate, nothing but the rate on the date of the transaction, that is 31st March 19. So it will lead to either gain or loss, referred as foreign currency fluctuations. These foreign currency fluctuations will be transferred to profit or loss account. It is 58 and $1 is 62. So what I have to do? I have to translate from 58 to 62. From 58 to 62 I have to bring. So it's nothing but loss because currency has appreciated, means dollar has appreciated, foreign currency has appreciated, it has become stronger. But say on 15/4/19 when I settle it, it has become 63. So what are we supposed to do if it is 63? My dear students, we will recognize again a loss of 1 rupees. And if it reduces, we'll recognize again. So that all depends on whether there is outflow or inflow, that we have to understand. Here of course there is an outflow of that. So this is nothing but with respect to foreign currency transaction, that all transactions are to be recognized at initial rate, and then whenever payment happens, the difference between initial rate and the settlement rate is gain or loss. But if payment is happening in the next year, then in between we will have translation gain or loss, that is on 31st March, we should recognize translation gain or loss. Now this is very simple, which you did in the class work also, that you have to pass and entries and all those things. Let me talk with respect to something very, very important from examination point of view also, that is para 46A. Now you learned that all currency fluctuations will go to profit or loss. That is true, but there is an exception, and that is para 46A. If the entity has adopted this optional accounting treatment, then only this para 46A will apply. Nothing but optional accounting treatment for exchange fluctuation. This is an optional accounting treatment for exchange fluctuation, that is para 46A. It says that if you have a long-term item, monetary item, means any item which completes at least 12 months period is referred as long-term monetary item, and this long-term monetary item is in relation to depreciable fixed asset, or it is in relation to others, then friends, what are we supposed to do? If it is in relation to depreciable fixed asset, then exchange fluctuations are to be capitalized. We are required to capitalize this exchange fluctuations if it is in relation to depreciable fixed asset. So whatever is exchange fluctuation, it will not go to profit or loss account, debit or credit as the case may. If it is gain, it's credited to P&L. If it is loss, it is debited to P&L. But para 46A, if this option has been taken by the entity, then whatever gain or whatever loss happens on that particular monetary item, that will be added to the cost of the asset or deducted to the cost of the asset. It depends on, if it is loss, it will be added. If it is gain, it will be deducted from the cost of the asset. But if this long-term monetary item means nothing but any item which is for 12 months, it is not applicable to short-term items. Any item which is there, monetary item is there for 12 months. If it is in relation to other items, then it says exchange fluctuations are to be transferred to FCMI TD account. Foreign currency monetary item translation difference, FCMI TD. Yeah, you have to transfer it to FCMI TD account and amortize. Here it is not to be added to the asset because it is for others. It's not in relation to depreciable fixed asset. So if it is in relation to others, exchange fluctuation will be accumulated under FCMI TD account, and this FCMI TD will go to P&L over a period of time. Clear? So this is with respect to para 46. Now coming on to another area of revision, that is foreign operations. Of course, this area will have a direct connection with branch accounts, which you are doing in advanced accounting. Yeah. So branch accounts, what you have already studied while doing classwork and all those things, in that you had something known as foreign operations, integral and non-integral, and you had foreign branch. So same thing is there. Here I'll just give a glance over it. Therefore, it is foreign operations. Then my dear students, what are we supposed to do in case of a foreign operation? Standard says in case of a foreign operation, the task is nothing but translation of financial statements. Translation of financial statements of foreign operation. What are we supposed to do? Whatever is the financial statement of that foreign operation, we have to translate it in our Indian rupees. So I have a branch or a subsidiary or a joint venture or an associate, whatever it may be, that is my foreign operation. What am I supposed to do? What am I required? I'm supposed to translate it into Indian rupees. So what are the rates to be considered? So for that purpose, the standard divides the foreign operation as IFO, that is integral foreign operation, and NFO, non-integral foreign operation, and it lists out the criteria. Like whatever is the monetary item in the foreign operation, it may be a debtor, creditor, loans, and all this. These things are monetary item. They have to be translated at closing rate. Means you will multiply it at closing rate and find out the rupees equivalent. Same way for NFO also, closing rate. If it is a non-monetary item, for IFO it is historical rate, but for NFO it is closing rate. For item of expense, loss, income, gain, it is basically actual rate, but for convenience we can use average rate. And whatever difference arises due to translation, of course that should be exchange gain or loss, transfer to profit or loss. Your exchange gain or loss is accumulated under FCTR, foreign currency translation reserve. Monetary item closing rate, non-monetary item historical rate, closing rate. This should be at average rate. Mutual transaction like holding, not holding, but I'll say head office has sold goods to branch, or branch has sold goods to head office, or as the case may be, then it should be at actual rate. Means the amount at which the transaction got recognized in the originator books. So this is all about your foreign operation, friends. Nothing big in this. For question answers, you should refer to branch accounts, which you have studied. Now coming on to the last area, that is forward contract. Forward contracts are of two types. Basically, what is a forward contract? Nothing but a contract entered to exchange currency on a particular date at a particular rate. So I'm going to exchange my currency. I'll give you dollar, I'll get rupees, or vice versa. So it's a contract entered to exchange currency on a particular date at a particular rate. That is referred as forward contract. This forward contract can be for hedge, means to protect ourselves from the risk of fluctuation, or this forward contract is for making gains from changes in the currency rates. So if currency rates are going to change, it is risk to me if I'm having foreign currency exposure. So I'm having a risk. So I want to remove that risk. So in order to remove that risk, whatever contract I entered to remove the risk, to eliminate the risk, is referred as forward contract for hedging. And if I use the forward contract to make profits, then it is referred as forward contract for speculation. Yeah. Now, what is the accounting treatment for hedging? Very simple. Standard says difference between forward rate, means the rate which we have decided, and spot rate. Spot rate is nothing but the rate of the currency today. Today, at what rate people are exchanging? So difference between forward rate and spot rate is recognized as exchange, or I can say premium discount. Instead of exchange premium, I'll just say premium or discount on forward. And sorry, the forward premium or discount is amortized, means we are going to transfer it to P&L over the tenure of forward contract. Now, my dear students, what is the accounting treatment for speculation? Means if I am entering into a forward contract and that is for speculation purpose, means I want to make profit or loss from it. I have entered into contract not because I am having existing risk. There is no risk of currency fluctuation, but I have entered into forward contract to make money from it, to gain from it. So that is nothing but accounting treatment for speculation. So what am I supposed to do? Nothing but standard says no forward premium or discount to be recognized. Means we are not supposed to recognize any forward premium or discount. Only the forward contract is to market, is to be marked to market. What does it mean, mark to market? It means you have to show it at market price. Whatever is the market price, show the forward contract at market price. Yes, friends, so this is all about the theory of AS11. The theory of AS11, of course, these are all basic stuff which I didn't revise everything, because what is definition, reporting currency and foreign currency. I've just revised what are foreign currency transactions and how foreign operations are to be translated, and forward contracts. Three major things, and of course para 46A. You would have done all the classwork questions, so let me move on to some homework question, and obviously thereafterwards past paper 2 questions I think are good enough for discussion purpose. We are revising, I hope so. You have already set for the lectures and now you want to quickly go through all those things. This is my purpose. Nowhere you should say that, sir, I have not studied at all. Will this lecture help me out? My answer is no. This lecture is for all those students who have already studied once and now they want to quickly recapitulate, quickly learn what they have learnt. So let us go for question number 1. STEM Limited purchased a plant for US dollar 30,000 on 30th November 2013, payable after 6 months. The company entered into a forward contract for 6 months at 62.15 per dollar. On 30th November 2013, the exchange rate was 60.75. How would you recognize profit or loss on forward in the books of STEM? Now friends, by reading this question only I can say this forward is for hedging. Why hedging? Because I purchased the plant and I have to pay after 6 months in dollars. So don't you think I have a risk that I have to pay after 6 months? So currency rates will change. This is the risk. In order to eliminate that risk, what have I done? I have entered into a forward contract. The forward rate is 62.5, the spot is 60.75. So can I say the premium is 1.40 per dollar? This is nothing but forward premium. It is 30,000. So the total loss on the contract is 30,000 into 1.40, 42,000. This 42,000 is my forward premium, or I can say loss on forward for 6 months. Out of this, can I say 4 months are here, December, January, February, March. So 42,000 into 6 not 6, into 4 by 6 will be expense for this year, into 2 by 6 will be expense for next year. Clear? Okay, the next question. This is solution, huh? The solution starts. Explain briefly the accounting treatment needed as per AS 11 on 31st March 15. Daters include amount receivable from Umesh, 5 lakhs rupees, recorded at a prevailing exchange rate of 58.50. Long-term loan taken from US company amounting to rupees 60 lakhs. It was recorded at 55.60, taking exchange rate prevailing on the date of transaction. US dollar is 61.20 on 31st March 15. Now, my dear students, first of all, daters, you have to convert this 5 lakh rupees into dollars and then find out that the rate today means initial recognition rate is 58.50 and now the closing rate is 61.20. So obviously daters have increased. My daters have increased. So it is a gain. But it is not 5 lakh gain. Huh? Don't say 5 lakh divided by 58.50, you will get dollars. And the gain is nothing but 61.20 minus 58.50 into those dollars. This gain will be credited to profit or loss account immediately. Why? So gain, P&L. Can I use para 46? Answer is no. Why? Because daters are short-term items. Para 46 is only for long-term monetary item. So, but obvious the next area, my dear, long-term loan is there. Here you can apply para 46. Of course, here also what you have to do is 60 lakhs first divided by 55.60. So, you will be getting number of dollars, units. This loan is recognized at 55.60. Today it is 61.20. So, there is a loss. Now, I have two options. If I am applying para 46A or if I am going with normal provisions of AS 11. If I am going with normal provisions of AS 11, this loss will be debited to P&L. But if I am applying para 46A, then the loss will be capitalized, will be added to the cost of the asset. If this loan is taken for a asset, if this loan is not taken for the asset, then the loss will be transferred to FCMITDA. Of course, here the question is silent, so we'll assume it's not taken for the asset. Yeah, so this is what we got, 8547 into this will be credited to P&L. Yeah, long-term loan, exchange loss, transfer to FCMITD account or profit or loss. Profit or loss if you're applying AS 11, FCMITD if you're applying para 46A. Yeah, of course, this theory has to be written for some questions. Rest all questions are repetitive. Let me do this one more question of November 18. I'll do one more, two, and one more question is there. ABC, an Indian company, obtained a long-term loan from WWW Private Limited, a US company, amounting to 30 lakhs. Can I say it is similar to what we discussed? At rupees 60, taking an exchange rate on the date of transaction. Exchange rate is 62. So first of all, my dear students, what will you do? 30 lakhs divided by 60. 50,000. And that 50,000 will be translated from 60 to 62. So there is a loss. This loss will be either capitalized if it is taken for a fixed asset. But here the loan is not taken for a fixed asset. So this loss will be transferred to FCMITD account. Alternatively, I can say it will also be transferred to P&L if you are not adopting para 46. And same thing is with trade receivables, my dear students. The same question what we did now in the homework section. See, it's been asked in November 18. Clear? Okay. Now, a small question with respect to Bansal and Company. Imported raw materials worth rupees US dollar 12,000 on 15 Jan 2019 when the exchange rate was 68. The payment for the transaction was made on 5th of May when the exchange rate was 64. At the year end, it is 65. The accountant of the company passed an entry adjusting the cost of raw material consumed for the difference between 64 and 68. Discuss whether the treatment is justified. Answer is no, it is not justified. The same type of question is there in our textbook also in classwork part. Now, what am I supposed to do? Sir, I bought the raw material at 68. Can I say now it is 65? So, first of all, on 31st March, we have to bring at 68 to 65. So, there will be gain. And then we are settling at 64. So, again, there is a gain. Yeah, so 3 rupees gain will be translation gain. And then again, 1 rupees gain will be referred as settlement gain. Settlement gain of 1 rupees. And it should not be adjusted to the cost of raw materials. That is wrong. Yeah. So, my dear students, this much from my side. Yeah, not a big standard, very simple standard this is, but you need to remember when to apply para 46A. Okay, so thank you very much for watching. Bye bye, dear students.